There is a single number that separates the greatest investor of all time from everyone else. It's not a secret formula locked in a vault in Omaha, Nebraska. It's a piece of simple arithmetic, a way of looking at a business that is so profoundly logical, so brutally honest, that it feels like a revelation. Warren Buffett calls it owner earnings, and he considers it the Holy Grail of financial analysis. While the rest of the world, from Wall Street professionals to retail investors, drowns in a sea of confusing, often misleading metrics, Buffett focuses on this one figure. He uses it to cut through the noise, to ignore the fiction presented in official reports, and to see the raw, unvarnished economic truth of a company. He claims that once you understand this number, you can analyze the core of any business in minutes. This isn't about complex algorithms or insider information. It's about a fundamental shift in perspective. It's about learning to see a business not as a stock ticker or a series of quarterly reports, but as something you personally own. And when you own something, only one thing truly matters. How much cash can you take out of it, year after year, without damaging the underlying operation? That is the question owner earnings answers. And in a world of accounting tricks and corporate spin, the truth is the most valuable commodity an investor can possess. Mastering this single concept is the first and most critical step in moving from a speculator guessing at stock prices to a genuine business analyst making executive-level decisions about capital allocation. This is the key that unlocks the entire philosophy of value investing, the bedrock upon which the entire Berkshire Hathaway empire was built. To truly grasp the revolutionary power of owner earnings, we must first understand the world it was designed to replace. We have to journey into the heart of modern corporate finance and confront the grand illusion that traps 99% of investors: the seductive, dangerous, and often completely fictitious number known as net income. It is the most quoted, most analyzed, and most celebrated metric in the financial world. It's the bottom line of the income statement, the figure that determines earnings per share, the number that sends stocks soaring or plummeting with every quarterly report. And it is, in many cases, a carefully constructed lie. The story of Enron Corporation is not just a tale of corporate greed. It is the ultimate foundational anecdote for why net income can be a weapon of mass financial destruction. In the late 1990s, Enron was the darling of Wall Street, a titan of the new economy. It was named America's Most Innovative Company by Fortune magazine for 6 consecutive years. Its stock price was a rocket ship, and its executives, Kenneth Lay and Jeffrey Skilling, were hailed as visionaries. The foundation of this entire edifice was a spectacular, ever-increasing net income figure. Quarter after quarter, Enron didn't just meet Wall Street's expectations, it shattered them. Their reported earnings grew with a smoothness and predictability that seemed almost magical. And that's because it was. It was an illusion crafted through an arcane and ultimately fraudulent accounting practice called mark-to-market accounting. In a normal business, you record revenue when you actually provide a service or sell a product and receive cash. Enron, with the blessing of their auditor, the now defunct Arthur Andersen, did something radically different. As an energy trading company, they would sign a long-term contract, say a 20-year deal, to supply natural gas to a utility. Instead of booking the revenue as the gas was delivered and paid for over those 20 years, Enron used complex mathematical models to estimate the total future profit of that entire contract and booked it all as net income in the very quarter the deal was signed. This was a financial fantasy. They were recognizing decades of hypothetical future profits as if they were real present-day earnings. The market, obsessed with net income, saw these fantastic numbers and cheered. The stock soared. But the cash wasn't there. A massive gap began to grow between the beautiful story told by the income statement and the ugly reality of the cash flow statement. To hide this growing chasm and to conceal the mountains of debt they were taking on to fuel the illusion, Enron's chief financial officer, Andrew Fastow, created a labyrinth of thousands of off-balance sheet entities, cryptic partnerships with names like Raptor and Jedi. These entities were used to hide debt and fabricate earnings, a shell game on a multi-billion-dollar scale. Analysts and investors, doing their supposed due diligence, looked at the income statement. They saw a pristine record of growth. They plugged the earnings per share into their models, declared the stock a strong buy, and moved on. They were blinded by the authority of a single GAAP-approved number. On October 16, 2001, the dam broke. Enron announced a restatement of its earnings, erasing over $1 billion of reported profit. The house of cards collapsed. Within weeks, the seventh largest corporation in America was bankrupt. The stock went from over $90 a share to less than $1. Billions in retirement savings vanished. Employees who had poured their life's work and their 401ks into the company were left with nothing. The story of Enron is the quintessential lesson in the perils of accepting accounting at face value. Net income, the number that built a $70 billion market capitalization, was pure fiction. The real economic engine was sputtering and failing, but as long as the accountants could keep the net income story alive, the music played on. This is the world Warren Buffett has railed against for over 50 years. He knew that the rules of accounting, known as Generally Accepted Accounting Principles or GAAP, allowed for a huge amount of leeway. They permit managers, whose bonuses are often tied to reported earnings, to make all sorts of subjective judgments about depreciation schedules, inventory valuation, and revenue recognition that can dramatically smooth, inflate, or otherwise distort the true profitability of a business. Net income isn't a hard fact like the temperature outside. It's a negotiated opinion, an estimate shaped by rules that can be bent and, in cases like Enron, broken. The reason so many intelligent people were fooled by Enron and continue to be fooled by similar, albeit less dramatic, accounting shenanigans today lies deep within the wiring of the human brain. The core psychological principle at play is a powerful cognitive trap known as anchoring bias. When we are presented with a piece of information, especially a number, our minds tend to anchor on it, using it as a reference point for all subsequent judgments and decisions. The first number we see heavily influences our perception of value, regardless of its actual relevance or accuracy. For investors, the net income figure is almost always the first and most prominent number they encounter. It's in the headline of every earnings report. It's what financial news anchors shout about on television. This number becomes the anchor. A company reports $2 in earnings per share, and our brain immediately anchors to that figure. We then evaluate the company's stock price relative to that anchor, calculating the P/E ratio and comparing it to other companies. But what if the anchor itself is set in sand? What if that $2 figure is a product of aggressive accounting choices rather than genuine business performance? The anchoring bias makes it incredibly difficult for us to adjust our thinking, even when presented with contradictory evidence. We are cognitively chained to that initial number. Compounding this is the authority bias, our innate tendency to attribute greater accuracy and importance to the opinion of an authority figure. In the world of finance, the authorities are legion: the company's management, the prestigious auditing firms who sign off on the financial statements, and the highly paid Wall Street analysts who issue buy and sell ratings. When a company like Enron reported record earnings, and a venerable firm like Arthur Andersen certified those numbers as accurate, and a dozen star analysts from major investment banks reiterated that the company was a strong buy, the individual investor's critical thinking faculties were effectively short-circuited. The sheer weight of perceived authority creates a consensus that is psychologically difficult to question. We think to ourselves, who am I to question these experts? They must know what they're doing. This creates a feedback loop of collective delusion. The company puts out a rosy net income number, the anchor, the authorities validate it, authority bias, and the market buys into the story, driving the price up and creating social proof that reinforces the initial belief. This is a perfect storm for poor decision-making, where fundamental analysis is replaced by a dangerous reliance on misleading headlines and the pronouncements of a compromised establishment. Warren Buffett's entire approach is designed to systematically override these biases. He doesn't allow the reported net income to be his anchor. Instead, he consciously discards it and begins his analysis elsewhere, typically with the statement of cash flows, looking for the cold, hard reality of cash generation. He actively distrusts authority, famously stating, "The business schools reward difficult, complex behavior more than simple behavior, but simple behavior is more effective." He has built his success not by being smarter than everyone else, but by being more rational and less susceptible to the psychological pitfalls that trap the vast majority of market participants. To immunize yourself from the dangers of the net income illusion, you must adopt a new mental model, what we can call the forensic accountant's mindset. This is not about becoming a CPA overnight. It's about cultivating a healthy, disciplined skepticism and learning where to look for the truth. It's a blueprint for piercing the corporate veil. Step 1 of this model is to invert the typical analytical process. 99% of investors start with the income statement. You will start with the statement of cash flows. This document is far more difficult for management to manipulate. While they can play games with revenue recognition and depreciation schedules on the income statement, the cash flow statement simply tracks the cash coming in and the cash going out. It is the heartbeat of the business. You are looking for one number in particular to begin your investigation: cash flow from operations, CFO. This is the cash generated by the company's core business activities before any investing or financing. Step 2 is to perform the great reconciliation. You will now place the net income figure from the income statement directly beside the cash flow from operations figure from the cash flow statement. In a healthy, honest, growing business, these two numbers should track each other reasonably well over time. Net income should be a decent proxy for cash earnings. If you see a company that is consistently reporting strong, growing net income, but its cash flow from operations is stagnant, weak, or even negative, you have discovered a giant red flag. This divergence is the primary symptom of accounting manipulation. It's the Enron signal. It means the profits are being manufactured on paper, but are not translating into actual cash in the bank. This single comparison is perhaps the most powerful 5-minute due diligence tool an investor can possess. Step 3 is to become a student of the footnotes. The narrative body of a company's annual report, the 10K, and the footnotes to the financial statements are where the company is legally required to disclose the accounting methods they've used. Most investors skip this section, deeming it too dense and boring. This is a catastrophic mistake. You must specifically look for the section on revenue recognition. How does the company define a sale? Do they book revenue when an order is placed, when it's shipped, or when the cash is collected? Aggressive policies here can inflate net income significantly. You should also scrutinize the, quote, allowance for doubtful accounts. If a company sells on credit, how much do they expect to not get paid back? A suspiciously low number here could be artificially boosting profits. Step 4 is to relentlessly question all non-cash and one-time charges. The income statement is littered with expenses that don't actually involve an outlay of cash, with depreciation and amortization being the most prominent. You must understand that the depreciation figure reported is an accountant's estimate, not an economic reality. Furthermore, be deeply suspicious of companies that frequently report, quote, one-time, unusual, or non-recurring charges to clean up their net income. If these charges happen year after year, they are not one-time. They are a regular cost of doing business that management is trying to sweep under the rug. Adopting this 4-step mental model, starting with cash flow, comparing it to net income, reading the footnotes, and questioning non-cash charges, shifts your entire perspective. You cease to be a passive consumer of a single misleading number and become an active, critical investigator of the business's true economic health. You are no longer playing their game. You are forcing them to play yours, the game of cash-based reality. The failure to adopt this mindset is what defines the path of the 99%, the road that so often leads to financial disappointment and ruin. The antithesis of the forensic accountant's mindset is the headline investor's approach. This approach is characterized by speed, superficiality, and a reliance on simplified metrics provided by third parties. The headline investor wakes up, checks their stock market app, and sees that company X, Beat earnings expectations. The stock is up 10% in pre-market trading. The headline reads, Company X posts record profits, EPS of $1.50 versus $1.45 expected. This is the only information they need. They don't download the 10K. They don't look at the cash flow statement. They see a positive headline, a rising stock price, and feel the powerful grip of FOMO, the fear of missing out. They buy the stock, feeling clever for having acted on the good news. What they fail to understand is that the entire game of beating expectations is a carefully managed charade. Corporate investor relations departments work hand in hand with Wall Street analysts to guide those expectations down to a level that the company can comfortably exceed, creating a positive news cycle. The reported earnings per share, EPS, derived directly from net income might have been inflated by a dozen different accounting tricks. Maybe the company changed its depreciation schedule, or released some of its cookie jar reserves from a previous quarter, or sold a factory and booked a one-time gain. The headline investor is oblivious to all of this. They are reacting to a number without understanding its origin or its quality. They are, in essence, a pawn in the company's public relations strategy. This path is paved with disastrous consequences. When you invest based on reported net income, you are outsourcing your thinking to the very people, company management, who have the greatest incentive to mislead you. You become susceptible to every bubble and every fraud. During the dot-com boom of the late 1990s, the path of the 99% was to ignore earnings altogether and focus on even more absurd metrics like eyeballs or website clicks. But for the more conservative of the bunch, they were led astray by GAAP net income that was being twisted and contorted to make unprofitable companies look viable. They bought into stories instead of realities, and when the crash came, their portfolios were decimated. The reason this path is so crowded is that it's easy. It requires no real work, no critical thinking. It feels good to be part of a crowd chasing a rising stock. It's the financial equivalent of a sugar high, briefly satisfying but ultimately unhealthy. The path of the forensic accountant, the path of Buffett, is harder. It requires patience, discipline, and a willingness to do the unglamorous work of reading dense financial documents. But it is the only path that leads to durable, long-term success in the world of investment strategy and wealth management. The direct financial connection between relying on the illusion of net income and the ultimate destruction of your capital is brutal and unavoidable. It's a time bomb embedded in the financial statements. Let's trace the explosion. A company, through aggressive accounting, reports $100 million in net income. The market, using a price-to-earnings multiple of 20, values the company at $2 billion. Everything looks wonderful. However, let's say that due to these accounting games, like booking revenue too early or understating expenses, the company's actual cash flow from operations was only $10 million. There is a $90 million gap between the reported profit and the cash reality. Where does this gap show up? It manifests on the balance sheet. The company has to balance its books. The fake $100 million in profit on the income statement must correspond to a $100 million increase in assets on the balance sheet. But since the cash didn't actually come in, this asset increase takes the form of things like accounts receivable, money owed by customers that may never be paid, or goodwill from an overpriced acquisition. The asset side of the balance sheet begins to bloat with low-quality, non-cash-producing assets. At the same time, the business still needs real cash to pay its employees, its suppliers, and its taxes. Since it's only generating $10 million in cash from its operations, but its expenses might be much higher, it has to get the money from somewhere. It does this by taking on debt or selling more stock. So while the income statement looks beautiful, the balance sheet is quietly rotting from the inside out. Liabilities, like debt, are climbing, and the asset side is filling up with junk. This can go on for a surprisingly long time, as long as lenders are willing to lend and investors are willing to buy into the net income story. But eventually, the day of reckoning arrives. A recession hits, credit tightens, or customers stop paying their bills. The company can no longer borrow money to cover its cash shortfall. The fake assets on the balance sheet have to be written down, a massive charge that obliterates a company's book value. The high net income figures of the past are revealed to be a mirage, and the stock price collapses to reflect the grim reality of the company's cash-poor position. Shareholder equity is wiped out. The $2 billion valuation evaporates because it was never based on the real, cash-generating power of the business. It was based on an accounting opinion. This is the ultimate financial consequence. Net income can create a valuation that is completely detached from economic reality. By focusing on it, you are valuing a story. By focusing on cash, you are valuing the business itself. The choice between the two is the choice between speculation and investment, and ultimately between losing money and building lasting wealth. It was this fundamental flaw, this built-in deception at the heart of corporate reporting, that forced Warren Buffett to develop his own tool, a way to cut through the fiction and find the truth. The year was 1986. The world of finance was accelerating, driven by the rise of junk bonds, leveraged buyouts, and a growing obsession with quarterly earnings. It was a time of financial engineering where complex structures and accounting wizardry were celebrated. And in his annual letter to Berkshire Hathaway shareholders, Warren Buffett, the oracle from Omaha, decided to pump the brakes. He penned a section titled "Owner Earnings and the Intrinsic Value of a Business," a quiet manifesto that would become a sacred text for true value investors. This was not the invention of a new, complicated formula. It was a call to return to first principles. The genesis of owner earnings wasn't a sudden flash of insight. It was the culmination of decades of experience, of watching businesses succeed and fail, and of a deep-seated frustration with the way the accounting profession misrepresented reality. The foundational anecdote that best illustrates this frustration and the philosophy behind owner earnings is his 1972 acquisition of See's Candies. On the surface, it was a simple transaction. Berkshire Hathaway, along with its partner Blue Chip Stamps, purchased the California-based candy maker for $25 million. The company was being sold by the See family after the passing of its patriarch. The numbers were good, but not spectacular by Wall Street standards. See's was earning about $2 million a year in after-tax profits, so Buffett was paying a multiple of about 12.5 times earnings. Many observers at the time thought he was overpaying for a simple, regional candy business with limited growth prospects. But Buffett wasn't looking at the reported net income in a vacuum. He and his partner Charlie Munger saw a different reality. They saw a business with a powerful, enduring brand, a moat in their terminology, that commanded incredible customer loyalty. More importantly, they saw a business with extraordinary economic characteristics that were completely obscured by conventional accounting. A typical manufacturing business requires heavy, continuous capital investment. To grow, it needs to build new factories, buy new machinery, and constantly upgrade its equipment. These expenses, known as capital expenditures or CapEx, consume vast amounts of cash and depress the real returns to the owners. See's Candies was different. The business was already established. Its kitchens were efficient. To grow sales, it didn't need to build a massive new factory. It just needed to open a new retail store in a shopping mall, which required a relatively small amount of capital for things like display cases and cash registers. Furthermore, the business had a magical cash flow cycle. Its busiest season was between Thanksgiving and Christmas. Customers would pay cash up front for their holiday gifts, flooding the company with money before it had to pay for its sugar, chocolate, and employee wages. This created float, a pool of cash that See's could hold and invest for its own benefit. When Buffett analyzed See's, he wasn't just looking at the $2 million in net income. He was performing a mental calculation of owner earnings. He saw the reported profit, but then he asked the crucial question: how much of this profit has to be reinvested back into the business just to maintain its current position, its competitive moat, and its unit volume? For See's, the answer was very little. The depreciation charges on the income statement, which were meant to represent the wearing out of its assets, were far greater than the actual cash that needed to be spent on new equipment each year. The business was a cash gusher. The $2 million in reported profit was not the end of the story, it was the beginning. The real owner's take was significantly higher. He understood that the cash generated by C's could be pulled out of the business and deployed elsewhere, into buying other stocks or other companies, without harming the candy operation. This was the economic truth. A business that reports $2 million in profit but has to spend $2 million on capex just to stay in the same place is worth nothing to an owner. A business like C's that reports $2 million in profit but only needs to spend, say, $300,000 on maintenance capex is a gold mine. It leaves the owner with $1.7 million in discretionary cash. This insight, born from the practical analysis of a humble candy company, was the seed from which the formal concept of owner earnings grew. Buffett realized that net income was a starting point, but it was corrupted by non-cash charges like depreciation, and failed to account for the necessary cash expenditures required to keep the business healthy. He needed a metric that reflected a business from the owner's perspective. The goal of a business owner is not to report a high net income. The goal is to generate surplus cash. The C's Candies acquisition became a cornerstone of the Berkshire Empire, not just for the hundreds of millions in profit it would eventually generate, but for the profound lesson it taught Buffett about the difference between accounting profits and real economic profits. It was the perfect case study in his search for economic truth, a search that led him to formally define owner earnings as the ultimate measure of a company's worth. The deep psychological principle that Buffett was leveraging, and that the concept of owner earnings forces you to adopt, is known as thinking in first principles. This is a mode of reasoning championed by figures from Aristotle to Elon Musk, and it involves breaking down a complex problem into its most basic, fundamental truths and then reasoning up from there. The opposite of first principles thinking is reasoning by analogy, which is what most people do most of the time. Reasoning by analogy means looking at what other people are doing or have done in the past and using that as your template. In investing, reasoning by analogy is the default setting. We see that Wall Street uses net income and PE ratios, so we use net income and PE ratios. We see that EBITDA is a popular metric for tech companies, so we use EBITDA. We are, in effect, copying someone else's homework without understanding how they arrived at the answers. This is intellectually lazy and incredibly dangerous because the underlying assumptions may be flawed. Buffett, in developing owner earnings, engaged in a ruthless application of first principles thinking to the question of business valuation. He didn't ask, what metric do other financial analysts use? He asked the most basic, fundamental question possible. If I own this entire business, what is it truly worth to me? To answer this, he had to ignore the established conventions of accounting and build from the ground up. The first principle he identified is that a business is worth the sum of the cash it can generate for its owners over its remaining life, discounted back to the present. That's it. That is the bedrock truth of all valuation. Notice that the words net income or EBITDA are nowhere in that statement. The fundamental unit of value is cash. From this first principle, the next logical questions flow. What is the definition of cash it can generate for its owners? Is it the net income reported on the income statement? No, because that includes all sorts of non-cash charges and accounting estimates. Is it the operating cash flow? Getting warmer, but not quite, because a business can't just give all its operating cash to the owners. Some of that cash must be used to maintain and defend its competitive position, to replace old machines, to upgrade technology, to keep the castle walls high and the moat wide. So the true cash available to the owners must be the operating cash flow, time minus the necessary capital expenditures to maintain the business's long-term health. By reasoning up from this simple, undeniable first principle, Buffett arrived at his concept of owner earnings. This process short-circuits our brain's tendency to take cognitive shortcuts. It forces us to deconstruct the jargon and the dogma of the financial industry and rebuild our understanding based on economic reality. It's a powerful antidote to the herd mentality. When the entire market is obsessing over a flawed metric during a bubble, the first principles thinker is insulated from the madness because their analytical foundation is built on solid ground. They are not reasoning by analogy to the crowd. They are reasoning from the fundamental truth that a business's value is tied to its ability to generate distributable cash. This is a far more mentally taxing way to operate. It requires you to question everything, to reject conventional wisdom, and to build your own intellectual framework. But it is precisely this deep, foundational thinking that separates the truly great investors from the masses. Owner earnings is not just a formula. It is the final output of a rigorous, first principles-based thought process about the true nature of a business. Now let's translate this philosophy into a concrete, mechanical blueprint. How do you, as an investor armed with a company's annual report, actually calculate owner earnings? This is the applied mental model, the step-by-step process for finding the economic truth hidden within the financial statements. Buffett himself laid out the formula in his 1986 letter. It is reported net income plus non-cash charges like depreciation and amortization minus the average annual amount of capital expenditures required to maintain the company's long-term competitive position and unit volume. Let's break that down into a practical, repeatable workflow. Step 1. Find your raw materials. You will need a company's annual report, the 10K. You can find this for any publicly traded company on the SEC's EDGAR database or on the company's own investor relations website. You will be focusing on the three main financial statements: the income statement, the balance sheet, and the statement of cash flows. Step 2. Start with the flawed number. Go to the income statement and find the line item for net income or net earnings. Write this number down. This is your starting point, the lump of accounting clay you are about to remold into economic reality. Let's use a hypothetical example. A company reports net income of $100 million. Step 3. Add back the major non-cash charges. The biggest of these are almost always depreciation and amortization, D and A. Net income is calculated non-after times subtracting D and A, but D and A is not a cash expense. The company didn't actually write a check to anyone for depreciation. It's an accountant's estimate of how much the company's assets have worn out during the year. To get closer to a cash number, we must add it back. Go to the statement of cash flows. In the cash flow from operations section, one of the very first lines will be the add back for depreciation and amortization. Let's say for our company, this is $50 million. So our calculation is now $100 million net income plus $50 million D and A equals $150 million. You should also look for other significant non-cash charges listed in this section, like stock-based compensation or asset impairment charges, and add them back as well. This subtotal net income plus non-cash charges is often a close approximation of what the company reports as cash flow from operations. Step 4. This is the most important and most difficult step, the subtraction of maintenance capital expenditures. This is where art meets science, and where true analytical skill is demonstrated. The statement of cash flows will tell you the company's total capital expenditures, CapEx, for the year. However, this total figure lumps two different types of CapEx together: maintenance CapEx and growth CapEx. Maintenance CapEx is the money the company must spend each year just to keep the business running as is, to replace worn-out machines, to keep the factories compliant with regulations, etc. This is a true expense for the owner. Growth CapEx, on the other hand, is discretionary spending to expand the business, building a new factory to enter a new market, for example. This is an investment, not an expense. The challenge is that companies do not separate these two for you. You have to estimate it. There are several ways to do this. A simple and often effective method, which Buffett himself has alluded to, is to look at the company's depreciation charge. In a business that isn't growing rapidly, the amount it needs to spend on maintenance each year is often roughly equivalent to the amount its assets are depreciating. So, as a starting point, You can use the company's total depreciation charge as a proxy for maintenance CapEx. In our example, the depreciation was $50 million, so we would subtract this from our subtotal. The final owner earnings calculation would be $100 million net income plus $50 million D&A, $50 million maintenance CapEx proxy equals $100 million. In this specific case, owner earnings happens to be the same as net income, which can happen for a stable, mature company. But now consider a different company. It also has $100 million in net income and $50 million in D&A. But this is a heavy industrial company, and you do some research and find that to truly maintain its aging factories, it has to spend $80 million a year on CapEx. Its owner earnings would be $100 million plus $50 million minus $80 M equals $70 million. The owner's real take-home pay is 30% less than the reported profit. This is the crucial insight. For a more detailed approach to maintenance CapEx, you can average the company's total CapEx over a full business cycle, say 7 to 10 years, and see how it relates to revenue growth. This granular level of fundamental analysis is what separates a professional approach from an amateur one. This entire blueprint, from finding the raw numbers to making a reasoned estimate of maintenance CapEx, is the mechanical process of thinking like an owner. It forces you to engage with the reality of the business, to move beyond the reported numbers and into the realm of true economic performance. The vast majority of investors never undertake this rigorous process. The antithesis of the owner earnings philosophy, the path of the 99%, is to embrace simplistic, flawed metrics that seem to offer a shortcut to understanding. The most popular and pernicious of these is EBITDA, which stands for earnings before interest, taxes, depreciation, and amortization. This metric became wildly popular in the 1980s during the leveraged buyout boom and has remained a favorite of Wall Street analysts and high-growth technology companies ever since. The logic, or rather the sales pitch behind EBITDA, is that it represents a, quote, cleaner look at a company's operating performance by removing the distortions of tax policy, debt structure, and non-cash depreciation. It's often presented as a proxy for cash flow. This is a catastrophic intellectual error. Warren Buffett and Charlie Munger have reserved some of their most scathing criticism for the use of EBITDA. Munger has famously said, "I think that every time you see the word EBITDA, you should substitute the words bullshit earnings." Why are they so hostile to it? Because EBITDA systematically overstates a company's true cash-generating ability by ignoring two very real, very cash-intensive costs of doing business. First, it ignores taxes. A company must pay taxes in cash. It is not an optional expense. Pretending it doesn't exist is financial fantasy. Second, and far more importantly, it ignores the A in EBITDA amortization and the D depreciation. By adding back depreciation and amortization, the metric implicitly assumes that a company has no need to spend money on capital expenditures to maintain its assets. It treats CapEx as if it were a discretionary choice. This is ludicrous. As Buffett has written, does management think the tooth fairy pays for capital expenditures? For any company that uses physical assets, from an airline to a software company with servers, there is a real, recurring cash cost to maintaining those assets. Ignoring this cost is analytically bankrupt. The path of the 99% is to accept EBITDA at face value because it's easy to calculate, and it almost always makes a company look more profitable and cheaper than it really is. A company might have a high PE ratio, but a low EV/EBITDA multiple, which gives the investor a false sense of precision and a false belief that they've found a bargain. This was rampant during the dot-com bubble. Companies that had no net income, and in many cases, negative operating cash flow, would tout their positive EBITDA figures. They were burning through cash at an astonishing rate, but by ignoring their massive capital spending on servers and their interest payments on debt, they could present a picture of health. Investors who followed this path were wiped out. The reliance on EBITDA is a symptom of a broader intellectual failure. The desire for a simple, single number that tells the whole story without requiring the hard work of genuine due diligence. It's a cognitive shortcut that leads directly off a financial cliff. Owner earnings, in stark contrast, forces you to confront the uncomfortable reality of maintenance capital expenditures. It is intellectually honest. It acknowledges that the tooth fairy does not, in fact, pay to replace a 20-year-old blast furnace or a fleet of delivery trucks. This is the fundamental divide in financial analysis between the easy, misleading fiction of EBITDA and the difficult, honest reality of owner earnings. The direct financial connection between using owner earnings and building a superior investment portfolio is profound. It all comes down to pricing power and accuracy in business valuation. When you buy a stock, you are buying a fractional ownership stake in a business. The price you pay should be a sensible function of the future cash you can expect to receive from that business. If your estimate of that future cash is wrong, your valuation will be wrong, and the price you pay will be wrong. By using owner earnings, you are anchoring your entire investment process to the most accurate possible measure of a company's cash-generating power. This gives you a massive analytical edge. Consider two companies, A and B. Both report net income of $1 billion. Based on this, the market has priced them identically, let's say at $15 billion each, for a PE ratio of 15. The average investor sees no difference between them, but you perform an owner earnings analysis. Company A is a capital-light software business. Its depreciation charge is $100 million, and you estimate its maintenance CapEx is also about $100 million. Its owner earnings are roughly $1 billion, the same as its net income. Company B is a heavy manufacturing company. Its depreciation charge is also $100 million, but due to inflation and the rising cost of new machinery, you calculate its true maintenance. CapEx is $500 million per year. Its owner earnings are only $600 million, $1 billion net income, plus $100 million D and A $500 million CapEx. Suddenly, the picture is completely different. The market is pricing both companies at $15 billion. But Company A is selling for 15 times its true owner earnings, $15 billion per $1 billion. Company B is selling for 25 times its true owner earnings, $15 billion per $600 million. Company A is dramatically cheaper and a far superior investment. The investor who relies on net income sees them as equal. The investor who uses owner earnings sees a screaming bargain in one and a dangerously overpriced asset in the other. This is how a durable edge is built in wealth management. It's not about predicting the next hot trend. It's about paying a rational price for a stream of cash. Over a long investment career, consistently paying lower multiples for real, distributable cash flow is a nearly unbeatable strategy. Furthermore, this analysis directly impacts your assessment of a company's quality and management competence. A management team that consistently generates high owner earnings relative to its net income is efficiently deploying capital. They are not squandering shareholder cash on low-return projects. A management team that presides over a company with low or negative owner earnings, despite reporting positive net income, is likely destroying value. This framework allows you to go beyond the numbers and make qualitative judgments about the skill of the company's leadership, a crucial component of any thorough equity research process. Ultimately, the financial connection is this. Owner earnings gives you a clearer, more reliable number to plug into your valuation models, leading to more accurate estimates of intrinsic value, which allows you to buy assets for less than they are worth. It is the critical first step in the chain of logic that produces superior, long-term investment returns. Now that we have established the philosophical and mechanical foundation of owner earnings, we must put it into practice. The true test of any analytical tool is not just its theoretical elegance, but its practical utility in making better decisions. This is the core of any successful investment strategy. The ability to translate a concept into a repeatable, disciplined process. The mental model required here is that of a capital allocator, a blueprint for thinking like Buffett, not just in how you analyze a company, but in how you act on that analysis. The calculation of owner earnings is not the end of the journey, it is the starting line. Once you have this powerful number, your task is to use it to make intelligent, data-driven decisions about where to put your money. The first step in this blueprint is to systematically screen for cash-producing machines. Instead of screening for stocks with low PE ratios, you will now screen for stocks with low price-to-owner earnings ratios. While most financial data services don't calculate owner earnings for you, they do provide the necessary components. You can screen for companies where cash flow from operations consistently exceeds net income, and where total capital expenditures as a percentage of sales have been stable or declining. This initial screen will filter out the Enrons of the world, the companies that are telling a good story with their income statement but are burning cash in reality. It will naturally lead you toward businesses with the economic characteristics that Buffett cherishes: capital light, cash-generative operations. Step 2 is to normalize the earnings power. A single year's owner earnings can be misleading. A business might have a particularly good or bad year due to economic cycles or one-time events. To get a true sense of a company's underlying profitability, you must calculate the average owner earnings over a full business cycle, typically 7 to 10 years. This smooths out the lumps and gives you a much more conservative and reliable baseline number to use for your valuation. This step requires patience, a trait most market participants lack. It forces you to take a long-term view, inoculating you against the market's obsession with quarterly performance. A company might have a bad year and its stock might get hammered, but if you've done the work and you know its 10-year average owner earnings power is robust, you can confidently buy when others are panicking. Step 3 is to compare owner earnings to the purchase price. This is where the rubber meets the road. Take your normalized owner earnings figure and divide it by the company's current enterprise value, market capitalization plus debt minus cash. This gives you the owner earnings yield. For example, if a company has an enterprise value of $1 billion and you've calculated its normalized owner earnings to be $100 million, the yield is 10%. This is an incredibly powerful number. It represents your pre-tax return on investment if you were to buy the entire company. You can then compare this yield directly to other available investments, like the yield on a 10-year government bond. If the bond yield is 4% and the business is offering you a 10% owner earnings yield, you are being well compensated for the additional risk of owning a business. This simple comparison provides a powerful framework for making rational capital allocation decisions. It turns a complex stock market decision into a simple business owner's choice. Which asset gives me the best cash return on my investment? Step 4 is to project, but conservatively. The final piece of the puzzle is to make a reasonable projection about the future growth of the company's owner earnings. Based on your fundamental analysis of the business, its industry, and its competitive advantages, you can estimate a growth rate for the next 5 to 10 years. A word of caution: be extremely conservative here. It's always better to be surprised on the upside. By projecting a conservative growth in owner earnings, you can then calculate a rough estimate of the company's intrinsic value and compare it to the current market price. The gap between your calculated value and the market price is your margin of safety, another core Buffett concept. This entire 4-step blueprint: screen for cash, normalize the earnings, calculate the yield, and project conservatively, is the operationalization of the owner earnings philosophy. It is a systematic process for finding high-quality businesses at fair prices. It is the intellectual engine of value investing, designed to remove emotion and speculation from the decision-making process and replace them with logic, discipline, and a focus on the only number that truly matters. To fully appreciate the superiority of this blueprint, we must once again examine the antithesis, the path of the 99%, and dissect the common, disastrous mistakes that stem from a failure to think in terms of owner earnings. We have already dismantled the folly of using net income and EBITDA, but the flawed thinking goes deeper, into the very way most people approach the concept of valuation itself. The most common mistake is what can be called relative valuation mania. This is the practice of valuing a company not based on its own intrinsic cash-generating ability, but purely by comparing it to other, often equally overvalued companies. The typical thought process is, Company X is trading at a PE of 30, and its competitor, Company Y, is trading at a PE of 25. Therefore, Company Y is cheap. This is analytically hollow. It's like saying that a house in an absurdly overvalued neighborhood is a bargain because it's priced slightly less per square foot than the house next door. Both might be terrible investments. As Buffett famously quipped, "A horse that can count to 10 is a remarkable horse, not a remarkable mathematician." A company that is simply less expensive than a ridiculously expensive peer is not necessarily a good investment. This relative valuation approach creates entire bubbles. During the dot-com era, companies with no earnings were valued based on price-to-sales ratios or even price per click. An analyst would say, "This new internet pet food company is a buy because it's trading at only 10 times sales, while its competitor is at 15 times sales." The fundamental question of whether any company should be worth 10 times its revenue was never asked. The entire framework was detached from economic reality, anchored only to the absurd valuations of its peers. The owner earnings approach is the antidote to this madness. It is a form of absolute valuation. It forces you to value a business on its own merits, based on its ability to generate cold, hard cash. The valuation of its competitors is largely irrelevant. Your analysis is anchored to the bedrock of the business itself, not to the shifting sands of market sentiment. Another common mistake is a complete misunderstanding of growth. The path of the 99% involves chasing growth at any price. They see a company whose revenues and net income are growing at 30% per year, and they pile in, paying exorbitant multiples for that growth. They fail to ask the crucial question: how much capital investment is required to generate that growth? A company that grows its net income by 30% but has to pour every single dollar of cash it generates, and then some, back into capital expenditures, is not creating any value for its owners. The growth is profitless from a cash perspective. The owner earnings calculation ruthlessly exposes this reality. If the required CapEx to fuel the growth consistently consumes all of the company's operating cash flow, the owner earnings will be zero or negative. This shines a bright, unforgiving light on what is often just value-destructive growth. A business that grows its owner earnings at a slower but still respectable 10% per year while requiring very little capital investment to do so is infinitely more valuable. These two core mistakes, valuing companies relative to their peers instead of their intrinsic cash flow, and blindly chasing growth without considering its cost, are the twin pillars of speculative folly. They are both born from an intellectual laziness, a desire to avoid the hard work of deep, fundamental analysis that the owner earnings framework demands. It's the siren song of the easy answer, and it consistently leads portfolios to their ruin on the rocks of economic reality. The direct financial connection of weaponizing owner earnings is the creation of a portfolio that is both more resilient and more profitable over the long term. It is the architectural blueprint for building true, lasting wealth. When you build a portfolio of companies selected based on their strong and growing owner earnings, purchased at a reasonable price-to-owner earnings multiple, you are constructing a financial fortress. This fortress has several key structural advantages. First, it possesses enhanced downside protection. Companies that gush cash have options. During a recession or a market crash, when credit markets freeze up and weaker, cash-burning competitors are struggling to survive, your companies can play offense. They can buy back their own stock at depressed prices, acquire struggling rivals for pennies on the dollar, or simply invest in their business to gain market share while everyone else is retreating. A strong owner earnings profile is the financial equivalent of a deep, food-stocked bunker in a storm. The stock prices of these companies will still fall during a panic, but the underlying business value remains intact, and often even grows, allowing the long-term investor to weather the storm with confidence. Second, A focus on owner earnings naturally leads you to businesses with strong competitive advantages, or moats. Businesses that can generate high levels of cash without massive capital reinvestment tend to be those with powerful brands, network effects, or regulatory protections. Think of companies like See's Candies, Coca-Cola, or Moody's. Their value comes from intangible assets, not from capital-intensive factories. These moats are what protect their profitability from competition, allowing them to generate surplus cash year after year. The owner earnings calculation acts as a quote-quote detector. If the number is consistently high and growing, it's a strong indicator that a durable competitive advantage is present. This is the Holy Grail of equity research. Finally, this approach directly translates into superior total returns. The return an investor receives comes from two sources: the cash distributions from the business, dividends or buybacks, and the growth in the underlying value of the business itself. Owner earnings is the source code for both. The discretionary cash flow is what funds dividends and share repurchases, directly returning capital to shareholders. And the portion of owner earnings that is retained and intelligently reinvested is what drives future growth. By focusing on businesses that maximize this number, you are simultaneously maximizing the two key drivers of long-term shareholder returns. The tangible financial result on your personal balance sheet is a portfolio that compounds wealth more reliably. Instead of the wild swings and stomach-churning volatility of a portfolio built on speculative growth stocks with no real earnings, you get the steady, relentless upward march of equity value, driven by a collection of businesses that are quietly and efficiently piling up cash on your behalf. This is the end game of value investing. It's not about being smarter than the market. It's about being more disciplined, more patient, and more focused on the one number that reflects the true economic reality of a business. It is the final promise of this entire analytical framework, a direct, measurable, and profound advantage in the pursuit of financial freedom. You have now absorbed a powerful mental framework, a tool of immense financial clarity. You've moved beyond the superficiality of net income and the dangerous fiction of EBITDA. You have learned to deconstruct a business down to its fundamental economic core, to see it through the eyes of its sole owner. The concept of owner earnings is not just another metric. It is a complete operating system for investment analysis. It forces you to ask the right questions, to cultivate a forensic mindset, and to ground your decisions in the unassailable reality of cash flow. This knowledge now permanently separates you from the 99% of market participants who are swayed by headlines, misled by accounting conventions, and driven by emotion. You now possess the analytical weapon that Warren Buffett has used for over half a century to methodically, patiently, and relentlessly build one of the greatest fortunes and businesses the world has ever seen. But it is crucial to understand that this powerful tool, this mastery of owner earnings, is but one pillar in a much larger intellectual structure. Warren Buffett's success is not the result of a single formula, but a latticework of interconnected mental models that support and reinforce one another. Knowing how to value a business with owner earnings is a vital skill, but it is most powerful when combined with his other core principles. It's like having the world's most powerful engine, but not yet having the chassis, the steering, or the roadmap. The calculation of owner earnings tells you what a business is worth, but it doesn't tell you which businesses you should be analyzing in the first place, or when you should buy them. The video that is now appearing on your screen is the next part of that map. It is the link that connects the what of valuation to the where and when of strategic decision-making. That next piece of the puzzle is designed to plug directly into the knowledge you've just acquired, to take your newfound analytical power and give it direction and focus. It will show you how to take the engine of owner earnings and place it into the chassis of a coherent, unbeatable investment philosophy. The choice you face now is not simply about watching another video. It is a decision about your identity as an investor and a decision maker. Are you content to have acquired a single tool? Or are you committed to building the entire arsenal? The path of the amateur is to learn one trick and stop. The path of the professional, the path of the true capital allocator, is one of relentless, continuous learning, of adding layer upon layer to their mental latticework until their thinking is robust, resilient, and superior. The next video is not a diversion. It is the continuation of your ascent. By clicking on it, you are making a conscious choice to continue that journey, to build upon the powerful foundation you have just laid, and to complete the intellectual architecture required for true, long-term financial success. The map is in front of you. Take the next step.